From our research team, the first piece they did for today is called, and we also have, just so you know, we have What's Your Assumption coming up, where we'll make as many of 10 trades as we can at right around 8:38.
40 or so.
Yeah, 8:38, 8:40 this morning. And right after that, then we have Jacob Perlman, our math geek, coming on to talk about VVIX and volatility on volatility and why the numbers look so funky sometimes, how the math works. But this one is how to trade iron condors in a low IV environment. All right, let's see where the team's going with this one. So the current market implied volatility is hovering near its lowest point, and lowest point, in recent history, and for the first time is much lower than the long-term average since the beginning of COVID. Long-term average, as you're seeing here, 15-year VIX average is 16.5. We're currently trading around 13. That is much lower, almost 20% below the long-term average. I think that's fair, and that's since the beginning of COVID. Let's go to the next slide. This makes the iron condor one of the most popular option strategies. And when we say one of the most popular option strategies, it's only because the iron condor is a delta neutral, easy to execute, short call spread, short put spread, sold simultaneously. And it's pretty easy for most people to understand. You're just hoping the stock ends up in the middle somewhere.
And relatively low amount of buying power for the credit received, too.
Right, relatively cheap to do. So one of the most popular option strategies.
Expensive.
Harder to execute due to the reduced premium and to the narrower profit zone. So in low implied volatility, just like our researchers say here, it is one of the most popular option strategies, and it is harder to execute. When we say hard to execute, we don't mean it's more difficult to get a fill. We just mean it's harder to kind of rationalize the execution because you're collecting less money and you have a narrower profit zone, okay? Because cheap volatility, lower expected move. Let's go to the next slide. The iron condor was built for high volatility. So the wings we select for iron condor will influence the risk-reward balance. So let's look at which ones do better in a market with low implied volatility. Are $5 wings better? Are $10 wide wings better? Or are $20 wide wings better? Mr. Batista, what do you think here? Would you like to go wider or more narrow?
Wider has been from our research has shown to be the best.
So in a low volatility market, Tony thinks you go a little bit wider because obviously you're kind of getting it to be a little bit more of a hybrid.
Of a strangle.
Yeah, like a hybrid strangle or somewhere between a strangle and an iron condor, that kind of thing. Let's go to the next slide. So we looked at 3 45 days to expiration SPY iron condors, each with a different width of wings. We're going to sell the 25 delta strangles, and then we're going to buy the $5, $10, and $20 wide wings. Okay, so just to make it, we're going to start with the same 25 deltas, and then we're going to buy the wings $5, $10, and $20 apart. All the positions we're going to manage at 21 DT because we do manage iron condors at 21 DT or 50% of max profit, whichever comes first. But it's really rare for 50% of max profit to come first before 21 days. Let's go to the next slide with an iron condor in low volatility. First, let's look at how the iron condor performs when implied volatility rank is above or below 25%. So this is implied volatility rank in the SPYs. And you can see it lives about, kind of looks like split down the middle there for the last 3 years.
Yeah,
about
pretty
above
much.
and below. Next slide. So we decided just to give you a little bit of, before we get into kind of the details. Well, actually, this is a lot of the details. IV rank below 25. What's the spider IV rank now? I don't have it right in front of me.
Spider IV rank is extremely low, it's single digits. IV rank is 4.
Okay, and above 25. The first thing you're going to know is the rate on 5s, 10s, and 20s is virtually the same whether the IV rank is below 25 or above 25. So IV rank does not affect POP, meaning your probability of profit is not going to be influenced by your IV rank.
Which should show you the efficiency of the market.
Yeah, the markets are just efficient no matter what. But what is impacted, there's a couple things. The first thing you start to see the impact on is the return on capital. When your return on capital is going to be about 10% higher to right around 10% higher. And in the case of the $20 wide, it's going to be about 20% higher.
Yep.
Okay, your return on capital. And then your monthly volatility, okay, that's going to be it's going to be a little tiny bit lower when implied volatility is higher. The narrow spreads is not going to be, it's going to be the same, but the spreads that are a little bit wider, they're going to have a little bit lower volatility, your position volatility. So you're going to have a higher return on capital, slightly lower volatility. The pop's going to remain the same. Let's go to the next slide. So now let's compare bullish years to bearish years. All right, now obviously most of the time the market has positive drift, so most of the time the market's been pretty bullish, and no change this year. Let's go. Last year was pretty bearish, but this year's been bullish. Let's go. Next slide. So during a bull market, wider iron condors did better, but when the market shift bearish, believe it or not, the smaller iron condors started to shine. So in a bear market, and this was surprising to me, the monthly volatility, although higher in bear markets than bull markets, the bull markets did significantly better than with return on capital, but the win rate went up a little bit. You know, basically bull markets, right? What are they trying to say here? During a bull market, a wider iron condor is better. Yeah, of course. But when the market shifts bearish, the smaller ones. Oh, I see what you're saying. The smaller, the where they highlighted it in green, the return on capital and the monthly volatility, which is really about return on capital. Return on capital was slightly better. I wouldn't highlight that as a major, advantage. I think the key here is that in bull markets, iron condors generally work better because the velocity of move is smaller and you don't get the volatility expansion, so you don't get the moves outside of the range. That's all there is to it.
Right, the volatility expansion would hurt a strategy like this that's selling volatility.
Right. So iron condors do a little bit better in bull markets. Makes sense. Let's go next slide. So in today's slightly bull market, which I guess we've been in a bull market pretty much this whole year, especially the NASDAQ, with decreasing implied volatility, using wider iron condors, such as $20 wings and SPY, can help us get better returns while lowering a person's volatility. All right, that's a good takeaway. Yep. Let's go to the next slide. So the final takeaways: no matter what their IV rank is, wider iron condors offer the most reliable and consistent returns, just like the bat said. However, when there's an extended sell-off or a bear market, tighter iron condors may be better to limit losses while generating a decent return on capital. Now, the hard part about this is it's really hard to know when you're in an extended sell-off or a bear market. Those things,
right? Where how do you
never really know, and you kind of like, so that's why it's really hard. We don't love narrow iron condors. They're kind of tough. I don't love them, so I prefer the wider iron condors regardless of market condition. But there's all your stats. It's good stuff.
Awesome, very good stuff. We're gonna take a quick 90-second break and come back with the opening bell next. It's Tasty Live.